Welcome to session 3 of the unit 2 of this our financial modeling course. In session 3 of the unit 2, we are going to focus on the simple regression estimation. So here we are going to estimate simple regression model. By the end of this session, you should be able to convert CAPM into estimable regression equation. That is CAPM, which is a capital asset price model. And you should also be able to estimate the beta coefficient. So with the CAPM, the beta coefficient represents the risk factor. And also you should be able to interpret simple regression model. Simple linear regression. So by simple linear regression, we are simply saying that we are establishing a relationship between two or more variables, that between a regressant and a regressor or regressors, where the relationship is termed to be linear. That is, we can use a straight line to explain, or we can draw a straight line between the relationship of these variables. So one popular basic and important financial model that we mostly use in the model estimation is the CAPM, that is the capital asset pricing model. So here we are with the CAPM, we are simply estimating the beta coefficient or the risk element of a particular financial market. So the CAPM is in the form RI minus RF, which is equal to alpha plus beta into bracket RM minus RF, where the RI minus RF is simply excess return. So excess return simply has to do with the returns that you are going to have, or the return given to or accrued to an investor who takes additional risk other than the normal risk, which is the investment in treasury bills or treasury bond. So RI minus RF is the risk-free rate. Alpha is constant. Here with the constant, we are simply saying that there is a possibility that some factors, or there are some factors that will affect our returns irrespective of the risk element. So this is represented by the alpha, and the beta is simply modeling or simply representing the changes or the risk element, the changes in the risk element. So here the RM is the market risk and the RF is the risk-free rate, which is mostly represented by the rate given by government on their treasury bills or treasury bond. And the EI is the error term that we already know. It captures other elements or other factors that affect the return or the excess returns, which are not explained by these models. So we could see that in this model, our focus is to capture the beta coefficient, that is the risk element in the investment of a particular financial asset. So in this illustration, we will use the equation 2.9. So we just will use other data sets. We have already established that we are not going to do this manually. We are going to use the eViews application. Therefore, we are being advised to use other data set. Here we are going to consider the beta coefficient or the risk elements in investing in the Ghana Commercial Bank stocks. Our data set is coming from the Ghana Stock Exchange, and we have already launched our eViews application, and we could clearly see that the data are being loaded. So after loading the data, we could see that we have the GCB data, we have the FMI, which is the Farm Bill Ghana, we have the date for the data set, and the GSEA-SI is the Ghana Stock Exchange All Share Index, that is the market risk, that one with the market risk, and the TB9, which is the treasury bill rate, represent the risk-free rate. So you could see that we have successfully loaded our data set into our eViews application. So here we have to understand that in calculating the excess returns, we are going to use our regressant, or the dependent variable is going to be the GCB stock prices, which we are going to convert, or we are going to transform into return series, and the RM the market risk will simply be the Ghana Stock Exchange, will be represented by the Ghana Stock Exchange prices or returns, and the RF will be the treasury bill rate. We have already established in our earlier sessions that it is important to use the return series other than the price series, and we have given reasons why we should use the return series other than price series, with one being the stationarity of return series, or what we call the stylized fact, which we said that there are some properties that the return series possesses which makes it better than the price series, and one is the stationarity, and also the autocorrelation, the absence of autocorrelation in return series, among others. So here we are going to calculate our return series using the eViews application, but we have to understand that in calculating the return series, we have to insert an equation so we have to go to the generate. We have to click on the generate on the eViews application, and it will bring us to this additional box. So it is in this additional box that we are going to generate our equation, which we are going to use in estimating the return series. So you could see that our return series is simply going to be For instance, that of Ghana Commercial Bank is going to be the GCB, which is the current price of the GCB minus the previous price of the GCB all over the previous price, and the same thing will be applied to the return series or the price series of the treasury bills or the treasury bond, that is the government treasury bill, which was in the regression was simply measuring the risk-free rate of the market, and the market risk is represented by the Ghana Stock Exchange. So we are going to also calculate the return series for the stock prices, that is the entire price, the entire stock index of the Ghana stock on the Ghana Stock Exchange. So after calculating the return series, we will click OK, and we are good to go. We are now, after forming our return series, we can now model or estimate our model. So after generating our returns, we have to understand that there is a need to also generate the market premium series that is in our e-news application. So we are going to, this is our model, which is the RI minus RF, as we have already established, and RGCB minus RTD. So the RGCB, so the RI is the RGCB and RF is the R Treasury bill. So the returns of the Ghana Commercial Bank stocks and the returns from the Treasury bill, that's the government Treasury bill. So this RI is equal to the GCB and RF is equal to the Treasury bill, and it will be equal to the returns of, and that is the excess returns of GCB. So the difference between the returns of GCB and the returns of the treasury, the returns from the investment in the treasury bill or treasury bond will give us the excess return, which is the ERGCB. And also, so we are going to use that in estimating our model. So RM is simply going to be the market risk, which is the returns from the Ghana Stock Exchange All Share Index, which is the returns from the All Share Index, and the RF is still our returns on the treasury bill or treasury bond. So this is our model. So after estimating, we have to know the parameters, we have to know what measures what. So here our regression becomes the RI minus the RF, which will be the excess return from the GCB, which we are trying to model, and our market risk will be the return from the Ghana Stock Exchange, and our risk-free is the treasury bill or treasury bond. So we click on the quick menu from this list of menus. So we click on the quick menu, and on the quick menu we will choose the estimate equation. So in the estimating equation, we have to understand that we have to have in mind how our model is going to be estimated, where the earlier equation shows that that's the equation 2.9, so that we are trying to measure the beta coefficient or the risk element. So here we are going to use a linear regression model other than using maybe a non-linear or other regression. So after clicking on the estimate equation, then we click OK. So here you could clearly see that we have selected all the variables that we are going to use in our estimation, like the date, the ARGCBN, among others. So these are the data that we are going to use in computing our regression model. So after clicking the estimate equation, this additional box appears, and in this box we are going to make some form of selections. So here we will see that we see specification, where we have equation specification. So you now specify your equation. What is your dependent, what is your independent? So our dependent, we earlier said, is the excess return of the GCB, and our independent will now be the beta coefficient, which depends on the market risk, that is the Ghana Stock Exchange, and the risk-free, which is the returns on treasury bills. So we choose the method, and here the method is the linear squares, or the ordinary least squares, or the linear square model. And this is the sample, that is the period from which we are starting and the period from which we are ending. You could clearly see that we are started from the 6th of January 2003 to to the 21st of April 2013. So after selecting your sample period and the method of model, then you click OK. You could remember from our earlier discussion that we said there are steps that we have to go through in building a model or in estimating models. And we remember we said that after estimating the model, the next thing is to interpret the result. That is, in the interpretation, we have to see, or we have to check as to whether the model fits, or it simply fits our theory, or it goes with our theory, or like it coincides with our theory, or otherwise. So after estimating the result, we have to check, or we have to interpret the result. in the interpretation of the result, we have to read meaning into the findings or the result that we obtain. So you could clearly see that this is our regression output from the CAPM after that's the model estimation. So the upper part will deal with the descriptives where we have the dependent variable stated as the excess return of the Ghana Commercial Bank, and the method has been stated as the least square, that is the OLS, and the sample period has also been given. We had 516 observations after a series of adjustments. That is after we computing the price from transforming the prices into return series and maybe other changes or also other adjustments. So we could see that we have the variables, we have coefficient, we have standard error, we have the t statistic, we have the probability value. The coefficient simply has to do with the result, that is the beta result, and the standard error we've already discussed that in our models we want the standard error to be as small as possible. That is the possibility of we making errors in our estimation as being measured by the standard error. So we want it to be as small as possible. And the p-value here, we are asked whether we will accept or reject the model depends on the p-value. So here we want the p-value to be less than the significance level that we have set for our equation. So you could see that we have a constant, that is the value, that is the alpha term in our model. Here, this one is the constant, the alpha term is the constant, and we have the market premium or the excess returns being estimated. So here we could see that we have 0.330716. So this is the value, the beta coefficient or the risk element in this market, and we have the standard error to be less than the coefficient. It is always advisable to see that your standard error should be less than your estimate for you to be able to accept the model. So the p-value also shows that our result is significant, because we set, let's say, the 0.000 indicator. Even if we set a significance level of 1%, still our model is significant, given that we have 0.000 probability value. And these are the other factors. The R-square. The R-square is what we call the coefficient of determination. It simply measures the changes in the dependent or the regression that is being explained by the regression. And the adjusted R-square is simply the R-square which has been adjusted for some series of errors. And all these are parameters that we are going to discuss later in this course. The standard deviation has to do with the measure of risk. The mean has to be the average. And we have the Akaikwe information criterion, the Schwartz criterion, the Hannan-Quinn criterion. These are all measures of the models. They are there to make sure that the model fit, or the model is fit enough to explain the relationship between these variables. So you could see that in our equation, our CAPM is simply has been modeled, and we could see that we have automatically inserted the values in it. So here our focus was on the beta coefficient, that is the risk element, and it was given as 0.330716. In our next session, we are going to discuss the meaning of these variables. Yeah, the beta coefficient is simply telling us as to how changes in the Ghana Stock Exchange and also the Treasury bills could affect the returns of the Ghana Commercial Bank. So here we are saying that the main point here is how regression has been able to show us the rate of changes in the Ghana Commercial Bank stocks as a result of the unit change in the market premium. It is thus clear that the Ghana Commercial Bank stock has a low risk, given that the value was 0.330. So here we are saying that if the market risk is 1, then we are saying that the Ghana Commercial Bank has a low risk compared to the investment on the Ghana Stock Exchange. So this is a desirable feature of the financial asset, as for every unit change in the market premium, the excess returns on the Ghana Commercial Bank changes by 0.33%. Specifically, for every unit increase in the market premium, the excess return on the Ghana Commercial Bank increased by 0.3. So we are saying that here we have direct relationship. There is increase. So when the market premium increase, the Ghana Commercial Bank returns also increase. So here there is not the relationship is not inverse, it is direct. So this example drives home very important point to note on regression. So after we have had some ideas, there should also be the need for us to understand that regression simply measure relationship. So here our focus is to measure the relationship between the Ghana Commercial Bank and the market premium. So there are 3 ways to describe the relationship between variables, and these are forms. By form, we are simply saying that we are measuring whether the relationship is linear or non-linear. So by a linear regression, or a linear relationship, we are simply establishing if a straight line can be used to describe the relationship between these variables. So sometimes we use a scatter plot, where we draw a straight line and see whether if the data sets are formed or they hover around the straight line. We can also use the degree. So by the degree, we are looking at the strength of relationship between these two variables, that is the regression and the regressor. So how close they are. So let's say a correlation of 0.44776 indicate that there is some form of relation, even though it is weak, because in correlation, if the correlation is above average, it's above 0.5, then we say it is strong. But with this one, we have 0.4, so indicating that our correlation is very weak. We can also use the variance inflation factor and also the tolerance factor, which we will discuss in in our remaining chapters, or we can also use the direction. The direction tells us as to whether the relationship is direct or it is inverse. By direct relationship, we are like the model that we estimated in this CAPM. For instance, we had a direct or a positive relationship where changes in the market premium or an increase in the market premium leads to a corresponding or a proportional change or increase in the Ghana Commercial Bank returns. So by direct, we are simply talking about increase in the regressor or regressors, leading to increase in the regressor. By inverse, we are saying that a decrease in the regressor or the regressors leads to an increase in the regression, and the opposite also applies here. So on the other hand, an increase in the regressors will also lead to a decrease in the regress. So when we said the relationship is inverse, it means a decrease here leads to increase here, or an increase here leads to a decrease here. So as we said, this is the plot that the scatter plot that we were mentioning earlier. So this is used to check the linearity of the series or of the model. So if the dataset is found, if we plot and we find that the dataset are found or they hover around this straight line, then we can say that the relationship is linear. Therefore, we can use a linear model to estimate the model, or estimate the relationship between these variables. So this is the scatter plot. So these are the data sets, and they are found around this straight line. So here we can say that we can use this straight line to describe the relation between the variables, as we discussed in our earlier slides. In summary, we've been able to convert CAPM into estimable regression equation. We've been able to estimate the beta of assets, and we've been able to interpret the result of our regression model. Thank you.